Welcome to Problem 14-4B, Entries for Bonds Payable and Installment Note Transactions. The following transactions were completed by the Montague, Inc., whose fiscal year is the calendar year. The instructions journalize the entries to record the foregoing transactions. 2016. July 1, issued 55 million of 10-year 9% callable bonds dated July 1, 2016 at a market effective rate of 7%, receiving cash of $62,817,040. Interest is payable semi-annually on December 31st and June 30th. To record this entry, we would debit cash, credit bonds payable, and credit premium on bonds payable, because the amount of cash we received was more than the face amount. For cash, we received $62,817,040. Bonds payable, whether it is a premium or a discount, is always credited upon issuance for whatever the face or principal amount of the bonds are. In this instance, $55 million. The amount that will be credited to premium on bonds payable is the difference between the cash and the bonds payable, $7,817,040. October 1st of 2016, borrowed $450,000 by issuing a 6-year 8% installment note to Inti Bank. The note requires annual payments of $97,342, with the first payment occurring on September 30th, 2017. To record this transaction, we are borrowing money from the bank, so we would just debit cash, and we would credit notes payable. And the amounts that get journalized are the amounts that we borrowed, $450,000. December 31st, 2016. We accrued $9,000 of interest on the installment note. The interest is payable on the date of the next installment note payment. Remember, what we are saying here is that we have incurred interest expense up to this point in time, and we have to accrue that interest in an account for interest expense and interest payable. The amount is the $9,000 which they say was accrued. If we wanted to check to make sure that they had done this correctly, we would take the principal amount, which is $450,000, times the 8%, which is what the note is, and then we have the months of October, November, and December, otherwise 3 months of the year. So we would take $450,000 times 8% times 3 divided by 12, and we should still come up with the $9,000. The second December 31st entry paid the semi-annual interest on the bonds. The bond discount amortization of $390,852 is combined with the semi-annual interest payment. We would have an interest expense, we would amortize out part of the premium on bonds payable, and then we would have cash because we are making the payment on the bond. Please note that the formulas put into the spreadsheet on this particular problem are incorrect, as it shows an asterisk, but we do have the correct accounts. We have incurred interest expense of $2,084,148. We are amortizing out the premium on the bonds payable in the amount of $390,852. The amount of the cash payment is $2,475,000. We find the $2,475,000 by taking the $55 million bond principal or face amount times 1/2 of the contract rate, 9%, divided by 2 would be 4.5% times the $55 million. To find the interest expense, the amount that we are amortizing out of the bond would be subtracted from the amount of cash that we are paying out, giving us this interest expense. The third December 31st entry for 2016 says that we closed the interest expense account. Well, to do this, it means we are closing it into income summary, and so there would be a debit to income summary and a credit to interest expense. And the amount that we would close would be the amount of interest that we had incurred in this year. Notice we had an interest expense of $2,084,148, but we also had another interest expense of $9,000. We would have to combine those two to be the amount that is being closed out into income summary. which would be a total of interest expense being closed into income summary of $2,093,148. 2017, June 30th, paid the semi-annual interest on the bonds. The bond discount amortization of $390,852 is combined with the semi-annual interest payment. This entry will look exactly like the December 31st entry in the year before. Seeing as how they are amortizing the same amount of premium out, we know that they are using straight line to amortize the premium. So again, this interest should look exactly the same. Interest expense, premium on bonds payable, and a credit to cash. And the amounts would be exactly the same also. September 30th, 2017, paid the annual payment on the note, which consisted of interest of $36,000 and principal of $61,342. If you remember, when we borrowed the money, the payments would be $97,342. Based on this information of that amount, the $61,342 will reduce the amount of the note payable, and the $36,000 is the total amount of interest incurred on the first date of the payment. You will notice that we have 3 debit entries because we are going to reduce the note payable by the principal amount that's being applied from that payment. We will have an interest expense, but we also have to take the amount that we accrued in the last year into interest payable off of our books also, and then of course credit cash for the total amount of the payment. So the September 30th, 2017 payment would be recorded as notes payable being reduced by the amount of the principal of that payment, $61,342. Interest expense is $27,000, which is the total $36,000 in interest minus the $9,000 that was accrued into interest payable in the year before, with a total cash payment of $97,342. December 31st, 2017, first entry. Accrued $7,773 of interest on the installment note. The interest is payable on the date of the next installment note payable. This, of course, would look just like the entry in 2016, where we debit interest expense, credit interest payable, but in this instance for $7,773. If you want to double check whether this was the correct amount, you would take the original $450,000, subtract the principal that had been applied to it in 2017, which was the $61,342. Take the result of that times the 8%, take it times 3, divided by 12, and you should still come up with $7,773. December 31st, 2017, the second entry, paid the semi-annual interest on the bonds. The bond discount amortization of $390,852 is combined with the semi-annual interest payment. We have already determined that this is being amortized at straight line, which means that the journal entry will look exactly like the June 30th payment from 2017. So we would have a debit to interest expense, a debit to premium on bonds payable, and a credit to cash. The amounts would be exactly the same as they were on June 30th. The third December 31st, 2017 entry is close the interest expense account. We would be closing it into income summary, so we would be debiting income summary and crediting interest expense. And of course the amount that would we record here is all of the amounts that were debited to interest expense during 2017. The amount, $4,203,069. This is a total of the June 30th, 2017 payment on the bond, the interest expense of $27,000 on September 30th for the note, the interest expense of $7,773 accrued on the note, the second bond interest payment of $2,084,148. All those added up give us $4,203,069. On June 30th, 2018, it says that we recorded the redemption of the bonds, which were called at 103. 103 means the percent of the face of the bond, which means to find out the amount of cash that we paid to retire this bond, we would take the $55 million, which is the principal amount of the bond, times 103%. This is the balance in the bond premium account, otherwise what has not been amortized out yet, is $6,253,632 after the payment of interest and amortization of premium have been recorded. It tells us to record the redemption only. In this journal entry, we find that we had a gain on the redemption of these bonds. Notice that we debit bonds payable if we are retiring these bonds, which is what is happening when we redeem them, is we are paying them off for whatever the face amount of the bonds were, $55 million. If you'll also recall that the premium that was left to be amortized out was $6,253,632, and to amortize that out or take it off of our books, we would have to debit it. The amount of cash that we are paying is $56,650,000. That would be $55 million times 103%. The difference between this total added up, subtracting the amount of cash, gives us a gain of $4,603,632. September 30th, 2018, paid the second annual payment on the note, which consisted of interest of $31,093 and principal of $66,249. The journal entry to record this payment, we have a debit to notes payable for the amount that is being applied to the principal. We have a debit to interest expense, which would be the $31,093 minus the $7,773 that we had accrued at the earlier point in the year, leaving us with $23,320. And of course, cash is credited for the amount of the payment on the loan, which it stated earlier is $97,342. Instruction number 2. Indicate the amount of interest expense in 2016 and in 2017. If we look at what we closed into the interest expense into income summary in each year, we should have our answers. So in 2016, the amount was $2,093,148. If we look at the amount closed in income summary in 2017, it is $4,203,069. Instruction number 3. Determine the carrying amount of the bonds as of December 31st, 2017. The initial carrying amount of the bond is what we initially issued the bond for, which would have been $62,817,040. Then we would take the amounts that were amortized each year, enter those as a negative because we will be subtracting them from the carrying amount since it is a premium. If it was a discount, we would be adding them to the carrying value. As you recall, the amount that we amortized out of the premium was equal each time we made an actual interest payment. That would mean at the end of December 31st, 2017, the carrying value of the bonds were $61,644,484. And that is the end of 14.4b.